Welcome to new episode of Inside the Economist's Mind. Today we're taking a deep dive into the world of cryptocurrencies and central bank digital currencies, or CBDCs. You're probably hearing more and more about these digital forms of money, and well, we want to help you understand what's really going on without getting lost in all the complicated tech speak.
Exactly. It can feel like a bit of a whirlwind sometimes. So our goal here is to unpack these concepts for you, clarify how they're different, and maybe explore what they might mean for the future. And we're drawing on some solid analysis, including from the Reserve Bank of Australia, to keep us grounded.
Okay, great. So let's kick things off with cryptocurrencies. In simple terms, what are they really all about?
Right. Think of cryptocurrencies as digital tokens. They let people send payments directly to each other online. It's kind of like passing digital cash from one person to another peer-to-peer.
Okay.
But the key thing to remember is that they don't have official backing from governments,
Yeah.
no legislated value. And their worth, it's purely based on what people in the market are willing to trade them for.
So it's all about supply and demand in this digital realm. And we're talking about things like Bitcoin and Ether here.
Yeah, those are definitely the big names you'll often hear. And the Reserve Bank's analysis points out there's been a huge, really significant surge in interest in these markets recently.
It definitely feels like everyone's talking about them. But the analysis you mentioned from the Reserve Bank seems to suggest this interest is more about speculation, right? More about potential profits than actually using them for everyday shopping.
That's a really crucial insight, yeah. The data suggests a lot of the activity, maybe most of it, is driven by speculation. People are hoping the price will go up so they can sell for a gain. Their actual use as a regular payment method hasn't really, well, caught on in a big way yet.
And the prices have been, well, all over the place, haven't they? Like a digital roller coaster?
Oh, absolutely. The volatility has been a major feature. It's quite stark. Take Bitcoin, for example. Its price shot up from around 30,000 US dollars in mid-2021 to nearly $70,000 by the end of that year.
Wow.
But then it dropped back down to about $35,000 in early 2022. And Ether and many others, they've seen similar, really dramatic swings.
Yeah, that kind of extreme up and down makes it pretty hard to see them as a stable form of money you can rely on day to day.
Exactly. That's one of the main issues when you think about them as money. And something else, what's happening behind the scenes. To keep these systems running, it requires a massive amount of computing power.
Right.
It's not just a simple click. It involves this global network of computers working constantly, solving complex problems.
Which makes you wonder, doesn't it, if they could ever really replace our regular payment systems or, even national currencies. The Reserve Bank seems a bit skeptical on that front.
That's a fair takeaway from their analysis, yes. And to understand why, maybe it helps to look at how a cryptocurrency transaction actually works, step by step.
Okay, yeah, let's do that. Give us the breakdown. Say, I want to send some crypto to someone.
Okay, so imagine Alice wants to send some cryptocurrency to Bob. First, she sends an electronic message out to the network. This message has Bob's unique digital address, the amount she wants to send, a timestamp, things like that.
Got it. Like sending an email with instructions?
Sort of, yeah. This transaction then gets bundled up with other recent transactions into what's called a digital block. You can think of this block like a page in a public notebook, a ledger.
Okay, a page in a public notebook. What happens to that page?
Right. So the information on this page, this block, it's then turned into a special kind of digital code using cryptography. And this is where the miners come in. These are people or companies with really powerful computers.
Ah, the miners.
Exactly.
Yeah.
They race against each other to solve a complex mathematical puzzle related to this code. The first one to solve it gets the right to add their page, their block of transactions, to the ongoing notebook.
The blockchain.
That's the one, the blockchain.
So it's like a competition to get your verified page added to this ever-growing public record.
Precisely. And once the puzzle is solved and the block is proposed, the rest of the network double-checks that the solution is correct. If enough users agree it is, the new block gets permanently linked cryptographically to all the previous blocks. That creates the chain.
Hence, blockchain. Okay.
And that confirms Alice's transaction to Bob. Usually, for extra security, the system waits for several more blocks to be added after that one, maybe 6 or so, before considering the transaction truly final, really set in stone.
So it's broadcast, group, solve a puzzle, verified, link to the chain. Wow. That's definitely quite a bit more involved than just tapping your phone at the counter.
It is, yeah. Different process entirely. Now, maybe we should switch gears and talk about central bank digital currencies, the CBDCs. How are they different from these cryptocurrencies we've been discussing?
Right, CBDC. It sounds much more official just from the name central bank. So what exactly is it?
Well, a CBDC, in its simplest form, is basically a digital version of the cash that a central bank, like our Reserve Bank of Australia, issues. Unlike cryptocurrencies, which kind of exist outside the traditional financial system,
Yeah.
a CBDC would be a direct liability of the central bank. It'd be a form of central bank money, but available digitally, potentially for everyday use by the general public.
And its value would be fixed, like the same as our regular currency, the Australian dollar.
Exactly. One digital dollar of a CBDC would always be worth one physical Australian dollar or $1 in your commercial bank account. Same unit of account, just in digital form.
So it's basically the money we use now, but purely digital, and it's directly backed by the central bank, by the government, effectively.
That's the core idea, and that's a key distinction from cryptocurrencies. Because it's issued and backed by the central bank, a CBDC has the potential to function like traditional money in three really important ways.
Okay, and those are?
Well, first, it could be widely accepted as means of payment. If it were given legal tender status, businesses would likely have to accept it.
Right.
Second, it could be a stable store of value over time because its value is pegged directly to the national currency. No wild swings like we see with crypto.
Okay, stability. Makes sense.
And third, it would use the national currency, the dollar, in our case, as the unit of account. Prices would still be in dollars, so it fits seamlessly into the existing economy.
Okay, that makes the difference much, much clearer.
Hmm.
So given all that, the big question, is cryptocurrency actually money in the way economists usually define it?
That is the big question. And according to the Reserve Bank's analysis, and frankly, most economic perspectives, the answer right now is no, not really.
No, why not?
Well, let's go back to those three key characteristics, those functions of money we just mentioned for CBDCs.
Okay, means of payment, store of value, unit of account.
Exactly. So first, means of payment. How widely accepted are cryptocurrencies? Well, not very compared to dollars. Most people, most businesses, still use traditional currencies for almost everything.
Yep.
Surveys suggest only a really small fraction of crypto owners actually use them for regular day-to-day transactions.
Right, you don't often see a pay with Bitcoin option for your coffee or groceries.
Precisely. Then second, store value. We already talked about the volatility.
Yeah, the roller coaster.
Those massive price swings really undermine their ability to reliably hold purchasing power over time. If your money could be worth 20% less tomorrow, it's hard to rely on it, right?
Definitely makes planning tricky. Okay, and the last one, unit of account.
Unit of account. Here in Australia and in most places, prices are set in the national currency, Australian dollars, not in Bitcoin or Ether. Even if a business does accept cryptocurrency, they almost always calculate the price based on the dollar equivalent at that moment. Their books, their thinking, it's all still in dollars.
Ah, so they might take the crypto, but the actual price tag is still denominated in dollars.
Exactly. So while you can use cryptocurrencies sometimes, they don't really function as money in that full traditional economic sense. A CBDC, however, because of its central bank backing and link to the dollar, could potentially meet all three criteria.
That's a very clear distinction. Interesting. So where are we at with CBDCs then? Is Australia or the world rushing to create them?
Well, there's definitely a lot of interest and a lot of research happening globally. The Bank for International Settlements, which is like a central bank for central banks, they say almost all central banks are exploring CBDCs in some form.
Almost all. Wow.
Yeah, but actually launching one,
Damn.
especially for major high-income economies, that's much rarer. Very few have actually gone live with the full public CBDC.
Okay. What about Australia specifically? What's the Reserve Bank's official position on issuing its own digital dollar?
The RBA has been quite measured, you could say cautious. In a 2021 speech, for instance, the head of payments policy pointed out that Australia already has a very good, very safe, and pretty efficient electronic payment system. Think debit cards, bank transfers, NPP.
Yeah, our current system works pretty well for most things.
That's largely the RBA's view. They argue that many of the potential benefits often cited for a CBDC, like faster or cheaper payments, are already being delivered or could be delivered by improvements to the systems we already have in place.
So their thinking is kind of, if it ain't broke, don't rush to fix it. Or at least the case isn't strong enough yet.
That seems to be the general idea, yes. They haven't yet seen a compelling public policy case to date to introduce a retail CBDC in Australia, mainly because our existing payment infrastructure is already quite advanced and serves most needs well.
Sounds like a cautious, pragmatic stance.
Right.
Okay, let's maybe zoom out a bit. What are some of the broader public policy issues that come up with cryptocurrencies beyond just whether they're money?
Right. There are several significant things policymakers are grappling with. One major concern is the potential for cryptocurrencies to be used for illicit activities, money laundering, financing terrorism, scams. The relative anonymity they can sometimes offer, combined with their global reach, makes them attractive for criminals.
That's a serious worry, that connection to crime.
Absolutely. And regulators are working on ways to mitigate that. Then there are concerns about the high levels of speculation in the markets. There's a real need for consumer protection, making sure people understand the very significant risks involved before they invest.
Yeah. Losing your savings overnight isn't ideal.
Not at all. Furthermore, if cryptocurrencies ever became much more widespread, it could potentially pose challenges for the traditional banking sector. And some worry about financial stability, especially if there were a sudden rush out of crypto or even a rush into crypto during a crisis.
Destabilizing effects.
Yeah.
And we can't ignore the environmental impact, can we? We touched on the energy use.
That's become a critical point, yes. The mining process, especially for Bitcoin using what's called proof of work, requires enormous amounts of electricity. Our sources mention estimates comparing Bitcoin's annual energy consumption to that of entire countries like Thailand.
An entire country. Wow. That raises huge sustainability questions.
It certainly does. It makes you think about the environmental cost of securing these networks.
Yeah, digital doesn't automatically mean green, does it?
Not necessarily, no. For anyone listening who wants to understand these risks better, by the way, ASIC's Money Smart website is a good resource here in Australia.
Good tip. Okay, now flipping back to CBDCs, what potential public good could they offer? What are the policy objectives they might support?
Well, a CBDC could potentially help maintain public trust in the concept of sovereign money itself, especially as physical cash use declines. It could also be a platform to promote further efficiency, safety, and resilience in the payment system. Maybe even foster innovation in payment services built on top of it.
So, providing a safe, official digital anchor in the financial system.
That's one way to think about it. Yes, a risk-free digital form of central bank money available to everyone. Research projects, collaborating with other central banks, really trying to understand both the technical challenges and the policy implications.
So they're not ruling it out, just being careful.
Exactly. As the governor said in a 2021 speech, while they haven't seen that strong public policy case yet for a retail CBDC in Australia, they are keeping a very open mind. Technology evolves, people's payment preferences change. They also acknowledge that these new forms of digital tokens, CBDC or otherwise, could potentially offer lower-cost payment solutions in certain niche areas eventually.
Right. So it sounds like they're carefully watching how everything unfolds. Very interesting. Now, we mentioned Bitcoin earlier as the most famous cryptocurrency. Maybe we could dig just a little deeper into what makes it tick. Where did it even come from?
Sure. Bitcoin emerged back in 2009. It followed the publication of a white paper or report by someone or maybe a group using the name Satoshi Nakamoto. Still a mystery who that actually is.
Right, the mysterious founder.
Yeah. And the core idea behind Bitcoin was to create a purely electronic system for cash transactions, allowing people to send money directly to each other online peer-to-peer without needing a bank or any other traditional financial intermediary. The aim was really to enable transactions based on cryptographic proof instead of trust in a third party, even between parties who don't know or trust each other.
So a truly independent, decentralized form of digital money was the goal.
That was the original vision, yes. And as we've already discussed, a key point is that unlike government-backed currencies, Bitcoin doesn't have any official or intrinsic value backing it. Its worth is purely determined by what people are willing to pay for it in the market. And it's important to remember, as we said, that value could theoretically drop to zero.
Right, definitely a high-risk situation. What about some of the key features of the Bitcoin system itself? How does it operate?
Okay, well, one really defining aspect is its predetermined and limited supply. The protocol dictates that the number of new Bitcoins created over time decreases, and the total supply will eventually be capped at around 21 million coins. Never more than that.
Capped supply.
Yes. And each Bitcoin can be divided into much smaller units called Satoshis, so you can transact in tiny fractions. This limited quantity is often compared to scarce commodities like gold, the idea of digital scarcity.
Interesting comparison. What else?
Well, the direct person-to-person transactions, as we mentioned, no central party verification needed. Instead, it relies on that blockchain technology, the shared distributed digital ledger to record all transactions and keep track of ownership publicly.
Okay. And the security, the integrity of that ledger comes from cryptography.
Precisely. The whole system's integrity is protected through complex cryptographic techniques. It makes tampering with past transaction records incredibly difficult, practically impossible if the network is strong.
And the mining process, that's how new transactions get confirmed and added, and also how new Bitcoins are actually created.
Exactly right. Mining is the process where network participants, the miners, validate transactions by solving those complex cryptographic puzzles we talked about. Solving the puzzle allows them to propose the next block to be added to the blockchain.
And they get rewarded for that.
Yes. The Bitcoin system is designed so that the difficulty of these puzzles automatically adjusts based on the total computing power directed at the network. The goal is to have a new block added roughly every 10 minutes. And the successful miner who adds the block is rewarded with a certain amount of newly created Bitcoins currently. It's 6.25 new Bitcoins per block. This reward halves periodically over time.
Ah, so that's the incentive to run those powerful computers.
That's the incentive. But this competition for block rewards is exactly what has led to that massive increase in specialized computing hardware and consequently the huge electricity consumption we discussed earlier.
It really is a fascinating but incredibly complex and resource-intensive system. And it's important we reiterate, just as our source materials do, that this discussion is purely for conceptual understanding. It's definitely not investment advice, given all the volatility and risks involved.
Absolutely crucial point. Anyone thinking about getting involved with cryptocurrencies really needs to do their own thorough research, understand the potential downsides, maybe check out impartial resources like ASIC's Money Smart website again. Be very careful.
Okay, so wrapping things up, we've taken a pretty detailed look at both cryptocurrencies and CBDCs today. What are the main takeaways you think we should leave our listeners with?
Well, I think the core difference really lies in their fundamental nature and backing. Cryptocurrencies like Bitcoin are essentially decentralized digital tokens. Their value is volatile, determined purely by market forces, and they lack official backing. CBDCs, on the other hand, would be a digital form of official government-backed currency issued by the central bank and directly linked to the national unit of account, like the dollar.
And based on the traditional functions of money.
Right. Cryptocurrencies currently don't really fulfill those functions. While limited acceptance for payments, too volatile to be a reliable store of value, and not used as a common unit of account. CBDCs, because of their design and backing, have the potential to fulfill all three of those roles, just like traditional money does now.
Okay. And while many central banks globally are actively researching CBDCs, here in Australia, the Reserve Bank is taking a more cautious wait-and-see approach for now, largely because our existing electronic payment systems are already quite advanced and working well.
That sums it up nicely, yes. But it's crucial to remember this whole digital finance landscape is still evolving very, very rapidly. Research is ongoing everywhere.
Things could look different in a few years.
They certainly could. It's definitely a space to keep watching.
So here's maybe a final thought for you to ponder. As our world becomes ever more digital, could the fundamental nature of money itself begin to evolve? Beyond just crypto or CBDCs as we understand them today, could the core concepts of value, exchange, and trust be reshaped in ways we haven't even fully anticipated yet? Something to think about. Thanks for joining us for this deep dive.